2023 was a banger year for the stock market, though recession fears are still looming over the economy. So, what should you expect in 2024? Stick around and let's get into it. Welcome back and happy 2024. I am your host as always, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter. So just wanted to give you a quick and very brief recap of 2023. For starters, the S&P was up big, I think over 20% or so as the end of last year. Bonds finally did what bonds are supposed to do, which is not go down 16%, maintain a relatively flat price throughout the year, and pay investors a steady stream of income. Bitcoin absolutely ripped in 2023, as did small cap stocks, specifically in the fourth quarter. International lagged a little bit behind the US, but still overall turned in double-digit returns. So overall, you really had to try hard to lose money in 2023. Now, the big question is what's on the horizon for 2024? Everyone wants to know what the markets are going to do in the future so that today they can sell their losers and lever up on those winners. Every time around this year when we start to get these market projections and outlooks for the year, I'm always reminded of this quote from best-selling author and management guru Peter Drucker, who said, quote, "Trying to predict the future is like trying to drive down a country road at night with no lights on while looking out the back window." It is so difficult to correctly predict what the economy and what the stock market will do tomorrow, let alone a year from now. Institutions come out now with their projections for the economy and for the stock market and for bonds for 2024. I think it's good to read those, but I wouldn't necessarily take that as sound financial advice. It's good to be aware of what's going on in the world, but honestly, that's kind of more for entertainment purposes, in my own opinion, and maybe even more for advisors than it is for retail investors to actually act upon it within their investment portfolio. So in this video, what I want to do today is really try and focus on the facts and really focus on what we know for reasonable certainty is going to happen in 2024, i.e., a presidential election. I also want to focus on and look at some data, specifically historical data in the market and the economy, to try and help us gain some clarity on how we could see stocks and bonds perform this year. And for fun, maybe I'll sprinkle in a few crazy predictions here and there because, hey, I'm a fun guy, despite what my kids say. Let's get into it. The first thing that investors can expect to see in 2024, I mentioned it earlier, is an election year. Now, I'm not here to predict who's going to win the presidency. I don't know if it's going to be Biden or Trump, or even if Trump will get the Republican nomination. But what I am for certain is that we're going to have an election. The big uncertainty right now is, okay, what does the market typically do in election years? How does the market perform? And I actually went back to data starting in 1928 all the way through 2016. And what the data shows is that during election years over that time frame, the S&P 500 was up on average 11.3% in all election years. And if we look at that data a little closer, when Republicans were in office or elected, the results in the S&P were about 15.3%. So that was the average return when a Republican was in office. Now, when a Democrat was in office, the returns were right around 7.6%. Now, don't kill the messenger here, okay? I'm not taking sides. I'm simply just reporting the data. I think the big takeaway here is that on average, the market's up 11.3% in all election years going back from 1928 all the way to 2016. Now, the worst election year was actually in 2008 when Obama was elected, and the S&P, if you remember, dropped almost 40% due to the housing market crisis. But outside of 2008, there have only been three other election years where the market declined, and that was in 1932, 1940, and 2000. So To put it another way, election years have yielded positive market returns 83% of the time. So if I look at that, the odds are in our favor that 2024 will be another strong year for the market. I want to focus real quick on those 4 years, right? Those 4 years that were actually down, the 4 election years that saw negative returns. So if we look at those 4 years, I think you're going to see there's more to the story than just an election year or a new president. 2008, as I mentioned, great financial crisis, right? The year 2000 was the internet bubble. 1940, as we all know, that was World War II, and 1932 was the Great Depression. So these were kind of like, I don't want to say black swan events, but major economic catastrophes that very few people saw coming before they happened. Now, will something like that occur in 2024? I don't know. I have no crystal ball on that. But if I'm just looking at the data and someone put a gun to my head and said, hey, you have to pick where stocks are going to be at the end of the year, I'm going to guess that we have a higher year in 2024 in the markets. Maybe not as high as we saw in 23, but I think we still see stocks go higher. Number 2, interest rate cuts. The consensus right now is for 3 rate cuts to start sometime in the second quarter. Now, I don't know exactly if that's going to happen or when that officially is going to happen. What I want to do real quick here is just go back a few years to 2021 before these rate hiking cycles even started. So it's 2021, early 21, when inflation really started to take off. And I think at the end of the year, average annual inflation rate was right around 7%, which was like 500% higher than in the prior year. We had inflation just ripping through the roof in 2021. And it wasn't until almost a full year later that Powell came in and said, okay, we need to start hiking interest rates to fight inflation. A lot of people have criticized Powell in the past for moving so slow in raising rates. But I look at that and say, if he was slow raising rates, what's to say that he wouldn't be slow cutting rates going on the other end? I think it's very possible that even though he has said, the Fed has said that there are going to be several rate cuts this year, and they're going to start maybe sometime in the second quarter, I think there's a lot more to it than just that. A great quote from JP Morgan's recent 2024 market outlook. Quote, some market declines and volatility would need to take place first during 2024 before easing of monetary conditions and a more sustainable rally. In other words, it's going to be difficult for the Fed to cut rates without really good reason or good reasons. So if you look at that and you look at the fact that how slow the Fed has moved in the past with raising rates, I think there's a good probability that we see rate cuts this year. I would guess they might be a little bit less than what the consensus says. Number 3, and this kind of coincides to my last point. Number 3 is more cash being put to work. So as of right now, there is roughly $6 to $7 trillion sitting in money markets and cash. In 2023, I think the fund inflows into money market accounts globally was about $1.7 trillion. And it's hard to blame depositors for that, right? I mean, interest rates were yielding 5% on very safe money market and high yield savings accounts. Why wouldn't you do that? Right now in 2024, a lot of commentators, a lot of analysts are expecting a big chunk of that cash to come out of money markets, out of savings accounts, and into the market. And the reason is that if we see rates coming down, if we have several rate cuts, well, that 5% yield on your money market account might not be 5%. It might be closer to 4 or maybe 3.5. So the big expectation to drive stocks higher this year is all of this money coming out of cash, going into the market to prop up stock prices. I don't think personally it's going to be as rosy as that. It sounds great. Okay, it makes for a really nice article. I just don't see that realistically happening. One, I just think the Fed's going to move a little bit slower than what a lot of people think. And 2, I think it really comes down to what the risk-free rate people are comfortable with. Is it 5%? Clearly, that was a definite indicator for 2023. Everyone was really, really happy with getting 5%, not worrying about the market. This year, is it 4%? Like rates come down to 4%. Is that going to spook investors into the market? Maybe, maybe not. I personally don't think 4%. I think a lot of people will still take 4%. If it gets down to 3, maybe 2.5, at that point, I could maybe see some money coming off of the sidelines going into the market, but I don't think it's going to be this huge wave that everyone expects, but I do see some of that. I mean, it's a lot of money sitting on the sidelines, $6-7 trillion. I think some of that's going to come off into the market to help support stock prices going higher in 2024. Number 4 is the equal weight index starting to outperform. So what do I mean by that? Let me go back real quick to the early 1980s and looking at the S&P 500. So in the early 1980s, IBM and AT&T were the 2 largest companies in the index, 2 largest companies really in the country. By 1994, IBM had completely dropped out of the top 10, and General Electric was now the biggest company. Then just 15 years later, ExxonMobil and Apple were the 2 most valuable companies. And if you look today, GE barely cracks the top 100 companies in the US. So I bring that up because right now what we have in the S&P 500 is the Magnificent Seven, or as you probably refer to it or heard of as the Mag 7. Apple, that's Microsoft, that's Amazon, NVIDIA, Meta Platforms, and Tesla. These 7 behemoth companies, trillion-dollar companies, make up more than 30% of the S&P 500. So 500 companies, 7 of them make up over 30% of that index. Now, it might not be this year, it might not be next year, but if history is a guide, those 7 companies are not always going to be on the top. At some point, there's going to be new incumbents that replace them. So the thought process here is that the heavily tech concentrated S&P 500 may no longer be the best performing index over the next year or 2. I think at some point, the other areas of the market, other stocks within the S&P 500 could start to take some of their market share. And that's kind of what I look at as the equal weight index. So the S&P 500 is a market cap weighted. It's weighted based on the size of the company in that index. So if Apple's the biggest company, they're going to have the largest share relative to the market cap or size of the other companies. An equal weight index is basically just taking those 500 stocks and spreading the allocation evenly across all of those 500 stocks. So it's I think from a risk adjusted return perspective, you could start to see that equal weight index perform better on a risk adjusted basis over time than something that's so heavily invested in just 7 stocks. I still think those 7 stocks will do very well. I don't know if all of them will, but I think AI, that story is definitely not going anywhere, and a lot of those companies still stand to benefit from it. But that doesn't mean that they're immune to some other company coming in, whether it's tech or not, and replacing them as the most valuable company. So I just want to bring that up because I think it's very important and something that a lot of people don't necessarily realize when they invest in the S&P 500 is that they have that concentration risk. They own just 7 companies that are over 30% of their overall allocation. Number 5, a new asset class is born. Something that we could see in 2024. I wish I would have gotten this video out earlier, but is what it is. So effectively, as of I think a few days ago, the SEC has officially approved the launch of spot Bitcoin ETFs. So basically what that means is now we have ETFs or funds that more closely track the price movement of Bitcoin. And this monumental decision has been highly debated and closely watched for years. And now what we'll have is retail investors, both large and small, having much easier access to the largest cryptocurrency in the world. Now, I don't know if that's a good or bad thing, but what I do know, what I am pretty certain of, is that big institutions, specifically BlackRock and Fidelity and WisdomTree, are going to be marketing these products and pushing these new Bitcoin ETFs that they have harder than ever. To take that a step further, I would not be surprised if, at least to start with these institutions that I just mentioned, if they don't start to recommend an allocation to Bitcoin or cryptocurrencies in their, let's say, their traditional 60-40 model. So instead of having like, let's say 60-40 in stocks and bonds, I could see those institutions start to recommend to their wealth management clients, hey, maybe we peel back a little bit of stocks and bond allocation and add 5 to 7% in this new asset class that we're calling cryptocurrency. I think that's very probable, especially as more institutions start to adopt cryptocurrency, introduce new products of their own, and more retail investors start to hop on board and the assets in these funds start to grow. I definitely think that cryptocurrency is going to stay for a while. I think it very well could become a brand new formal asset class that some of these fund managers use when investing clients' money. Lastly, what could we see in 2024? And this is probably my least favorite one, but I have to say it, is a WTF event that plunges the US into a recession. So I want to start here with a quote from Carl Richards, famous author and kind of like a guru in the financial planning space. So Carl said, quote, "Risk is what's left over after you've thought of everything." And I think that's so important to address now because I hear a lot of people ask me, hey, Eric, what do you think about interest rates? What do you think about the economy? Do you think it's growing? Do you think we're in a risk of a recession? Do you think the war is going to cause a recession? Do you think all these different things? And honestly, the answer is no, because those to me aren't really risks. We all know about them. We're all aware of the potential outcomes of what those could lead to in the economy and the markets. Have already been accounted for and discounted in the stock market. So to me, those aren't really risks. The risks are the things that no one sees coming. Okay, you go back to COVID-19. Very few people thought that COVID-19 would become what it did. Go back to 2008, the great financial crisis. There were a handful of people, maybe more, in the entire world that thought the market was going to crash because of the real estate disaster. It's very difficult to see these things coming. Almost no one can see these catastrophes, these black swan events happening. That's really what risk is. I don't think something like that is going to happen in 2024, but honestly, it's almost impossible to predict because you can't predict it. That's really what risk is. So I would be remiss if I didn't at least mention the possibility of some kind of event happening this year that's completely unexpected, or maybe it's something that is anticipated, but it ends up being far worse than what a lot of people expected it to be. What are your predictions for 2024? Do you think we'll see another double-digit year for stocks? Or do you think we're going to enter into a recession? Please respond in the comments below or shoot me an email with your takes on 2024. I'd be really interested to hear them. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.